It's just a couple of hours of trading, but, it looks like maybe there's finally some catch up going on here with higher rates.
Today has not changed my mind. No. And you couldn't have said it better. We do think that 23 will likely be the inverse of 22. And, this is a period where we might finally get that slowdown. Although that slowdown appears a bit elusive right now, earnings may come in a little bit. And yet the market is likely to go up because we've already had sell-off last year, 25% down peak to trough, anticipating the recession that just continues to look elusive. And I think the argument has nuanced a little bit. It's gone from, the fundamentals are surprisingly strong. They're mixed at worst, but they're stronger than people anticipated. And as a result of that, we're starting to get this no landing argument. And just like human nature, we just always go to worst case outcomes. So it seems like everybody, or at least today, people are jumping to the conclusion if the fundamentals are stronger, that means that inflation will be higher and hotter and the Fed's going to have to continue to raise, and that's going to cause a hard landing. I don't know why we have to jump to those conclusions. You can have stronger than expected economy and yet inflation continue to calm as these supply chain bottlenecks that were driven by pandemic and unusual circumstances continue to ease. So why can't you have improving productivity, falling inflation, which is the evidence of the day right now, and a little bit stronger economy? And therefore, to me, that signals recovery and healthy movement from here, not worst case like people jump to.
No, I like it. It's gold. Not a lot of people are talking about Goldilocks right now, but when you look at the way energy prices have fallen and they punch way above their weight in terms of psychological value, headline inflation, all the rest of it, and that's really come down. Let me ask you the question this way. A question from Lee J, one of our viewers, who says, if all of this is the case, why is the market still trading at 18 times? In other words, it's not exactly a bargain right now, given what he says, the macro headwinds and how earnings have come in. He says, I'm baffled. What are your thoughts?
Well, I think that there's no reason to think valuation can stay at a slightly higher or much higher level than is average. So let's say that over the last 5-10 years, it's been somewhere around 16 times is the average. We're slightly elevated. And I think that they contracted from 22 times, which were way higher than where we're at right now, because rates rose last year. Maybe it wasn't because of, fear of earnings slowdown and recession. It was simply that we got PE multiple contraction as rates came up and inflation rose. Perhaps they can not only stay at these levels, but elevate a bit from here to that 19, 20 times level if inflation stays under control and the fundamentals are okay. I don't see any reason why PEs would have to collapse if inflation is trending better and price pressure is getting better, the margin pressure is easing. That, to me, would say we could sustain these PE levels or maybe even see them expand just a little bit. Maybe not back to 22 times. Maybe that was too rich. But somewhere between where we are and that point.
Oh, that's
how I would look at it.
Again, Jeff, this is why I love you. Not many people are going to come on right now and argue for multiples expanding in this kind of environment. So let me give you one more from Kang, one of our viewers, who says the market basically ignored the Fed in 2022 and got smacked. Why would they do that again? And we see this today. We just talked about this with Steve, where they're finally going, okay, maybe we are taking rates over 5% by the end of the year. If that all plays out, how do you feel about stocks in the meantime?
Well, our base case is built in with Fed funds somewhere around 5.25, which would be a couple more 25 basis point hikes. And I think we have to put things in perspective again. I'm not a raging bull here. I just think that we could see upside after a 25% peak to trough correction last year. And, people, again, they jump the worst case. I hear comments like, oh, my God, this is unprecedented what the Fed has done. And yeah, we have gone from 0 to 5-ish in Fed funds, but what was unprecedented was 0. We were at 0. We're only going back to normal. So, as Mohammed El-Arian comes on and talks about the new normal years ago, which was a brilliant kind of spin on things, we're going back to the old normal. We're just going back to normal and people are freaking out. And I just think you need a little more poise and patience to see that it's not as bad as folks think. And in fact, the market trades on trend, not on absolutes. And if you don't believe that, think of 2009 when the market was up 30% while earnings cratered 47% and we were losing 500,000 jobs a month.
Right.
And yet the market was up. And that's all I'm saying. The logic should unfold. The market cares about where we're trending, not where we're at. And I think that we're moving in a better direction.